Want to pull profits in the market without being glued to your screen all day? If you read tired of the frantic pace of day trading, but do you not want to wait months or years for your investments to grow? Then you need to understand swing trading. This is a strategy designed to capture powerful, explosive market moves that unfold over just a few days to a few weeks. It's the perfect middle ground, blending the excitement of short-term action with a much more relaxed, strategic approach. So, what exactly is swing trading? Think of it like surfing. You're not trying to catch every tiny ripple in the water, and you're not waiting for a once-in-a-lifetime tsunami. Instead, you're looking for those perfect, powerful waves that transcend riding them for as long as they have momentum. In trading terms, this means you're holding a position for more than a day, but usually less than a month. Your goal is to capture one significant swing in price, whether it's moving up or down, and then get out. This approach frees you from the need to constantly monitor the charts, allowing you to set up your trades and let the market do the work. It's about being efficient with your time and capital, targeting the most probable and profitable moves. Now, let's get into the mechanics. How does this actually work in practice? The foundation of a solid swing trading strategy is multi-time frame analysis. The pros don't just look at one chart. They look at several to get the full picture. Your primary workspace is the daily chart. This is where you will spend most of your time identifying potential setups, the patterns and signals that tell you a big move might be coming. You're looking for classic patterns like pullbacks to a key level, breakouts from a consolidation range, or signs of a major trend reversal. But before you even think about placing a trade, you need context. That's where the weekly chart comes in. The weekly chart is your trend filter. By zooming out, you can see the dominant long-term direction of the market. Is the overall trend bullish, bearish, or is it just moving sideways? You only want to take trades that align with this bigger picture. For example, if the weekly chart shows a strong uptrend, you'll focus exclusively on finding buying opportunities on the daily chart. Trading with the trend is like swimming with the current. It makes everything easier and increases your odds of success. Once you've confirmed the macro trend and identified a promising setup on the daily chart, you can zoom in one more level to fine-tune your entry. This is where the 4-hour chart can be incredibly useful. It gives you a more detailed view of the price action, helping you pinpoint the exact moment to enter the trade with precision. This could be waiting for a specific candlestick pattern to form or for price to break a small intraday resistance level. To identify these opportunities, swing traders use a toolbox of technical indicators. These aren't magic crystal balls, but rather tools that help you read the market's psychology. The Relative Strength Index, or RSI, tells you if an asset is overbought or oversold, signaling a potential reversal. The MACD, or Moving Average Convergence Divergence, helps you gauge momentum and identify changes in the trend strength. Moving averages are fantastic for quickly identifying the trend and acting as dynamic support or resistance. And, of course, the most fundamental tools of all are support and resistance zones, horizontal price levels, where buying or selling pressure has historically been strong. By combining these tools, you can build a robust system for identifying high-probability setups. Knowing when to get in is only half the battle. Knowing when to get out is where traders truly make their money. Your entry signal needs to be clear and decisive. A common entry trigger is a breakout above a key resistance level, especially when it's accompanied by a significant spike in trading volume. That volume confirms that there's real conviction behind the move. Another classic entry is buying during a pullback in an uptrend, waiting for the price to bounce off a moving average or a support level, showing that the trend is ready to resume. Once you're in a trade, you must manage it with discipline. Every single trade needs a predefined exit plan for 3 scenarios. First, your profit target. This is the price level where you plan to take your profits. Second, your stop loss. This is an order that automatically closes your position if the price moves against you by a certain amount, protecting your capital from large losses. It's your safety net. And third, a reason for an early exit. This could be if momentum suddenly dries up or if the underlying trend structure breaks down. A core principle of successful swing trading is managing your risk-to-reward ratio. You should only take trades where the potential profit is at least twice as large as your potential loss. This is known as a 2-to-1 reward-to-risk ratio. Why is this so crucial? Because it means you don't have to be right all the time to be profitable. If you risk $100 to make $200 on every trade, you could be wrong on half of your trades and still come out ahead. This is the mathematical edge that separates professional traders from gamblers. Ultimately, swing trading is a game of patience, precision, and discipline, not emotion or guesswork. It's about waiting for the perfect setup to come to you, executing your plan flawlessly, and managing your risk like a business. It's a strategy that can fit around a busy schedule and deliver consistent results once mastered. If you found this breakdown helpful and want to see how this all comes together in the real world, I'd love to show you. If you want me to create a detailed video breaking down a real swing trade, step by step from finding the setup to taking profits, hit that follow button and comment swing down below. Thanks for watching, and I'll see you in the next one.